Hello and welcome to BQ Prime. We're heading into another monetary policy where the narrative is a touch different from what it was just a couple of months ago. The focus right now is on the probability of a US recession, what that could mean for commodity prices, and whether that means that inflation concerns may have peaked. Is that turn in narrative, if not environment, enough to bring about a soft pivot in the RBI's and the MPC's message? Let's talk to Indranil Sengupta of CLSA about all that and more. Indranil, thank you so much for taking the time to speak to us.
My pleasure.
Indranil, I'll just start with the basic take. There seems to be, even within the domestic central bank, a feeling that inflation has peaked. Firstly, would you go with that sort of expectation?
Yes, I think inflation has peaked at home. Uh, Barring a spike that we'll see in September, October on base effects towards 8%. So that's the good news. Uh, the bad news is that, even then inflation will be above the RBI's comfort zone or very close to the RBI's comfort zone. We are actually looking at 6.3% in March, and the trajectory right now is tracking that. So therefore, clearly you need to take more steps to bring down inflation. The other issue is that increasingly there seems to be a lack of rain in the rice fields in the east, and while there are buffer stocks to contain the impact on rice prices, let us see how that goes, because obviously you could get a good rain and solve the problem, but let us see how that goes.
So we're still, for the year average, tracking, I think the RBI's number was 6.7 for the current year. Correct me if I'm wrong. That holds, or do you think there's some downside there?
So we have a marginally higher number of 6.9%.
Okay.
Maybe 30-40 basis points here and there, depending on how oil and how the water goes. So the rains go. But broadly, I would say that, it is in that zone, plus minus 20 basis points.
Okay. So if that's the case, then while there is comfort in the fact that inflation may have peaked, it probably then won't veer the RBI and the MPC away from the tightening path which they had sort of laid down in the last couple of policies.
No, I would imagine not. We are looking at a 50 basis point hike this time round as well. And, yes, maybe next year inflation gets back to the fives. We are looking at a 50 basis point cut in rates next year. But there is a battle to be won. So you need to win the battle first.
They are not then sort of disinflating towards 4% yet. I mean, because in your forecast that I saw in a report that you put out, I think a month ago, you're still expecting even FY24 inflation to be well above that 4% midpoint, right?
Yeah, so that there are two things here. Number one, I think it's partly driven by our house view that oil will average $100 odd. That's number one. And number two, I think that the growth maximizing inflation for India is around 5.5%. And this is something I've written for long. And in fact, if you see, the RBI has also come out with similar research now. So going towards 4% actually needs, a sacrifice of growth, which is perhaps not necessary, especially in a world where growth is so scarce.
And I guess the way the inflation targeting sort of framework has been laid down, they do have that flexibility.
Yes.
I mean, not everybody would agree they have it, but they seem to be taking it for sure.
I am a votary of taking it, especially in times like this.
How much is the Fed's sort of trajectory going to force their hand? If, for instance, our inflation looks like it's peaked, of course, in the US, the debate will continue, and the gap between their target and actual inflation is much wider. But if the Fed is going to keep hiking, how much of a factor is that going to be for the RBI?
So I think you have to keep a differential of at least, let's say, 200 basis points. And, it's just not us. Every central bank in the world has to, move if the Fed moves. So, even in 2006, when the Fed, went to 5%, so, the RBI had to hike. Once the Fed stops, maybe then you cut, but then you have to hike or you lose the currency. Now, it's true that both in 2006 and now, the RBI has high FX reserves. But why, uh, there is no point losing FX reserves right now, because there is a tough road ahead. So you want to preserve high FX reserves for any further global shock, given the nervous environment. So I think
I'll
that
get to.
you have to hike if the Fed hikes.
Okay. Just I'll get to the FX side in a bit, but can you explain the differential that you were talking about in US rates and local rates? What history tells us is, a level where, you're more or less in balance and where things start looking iffy?
So I think the historically the average has been 500 basis points, because the Fed was at zero for such a long time when we were at high rates. But if you go by the experience of 2006, especially, which is one test case we have, 200 basis points seems to be a fair game, especially now that Mr. Das has built up high FX reserves. So from that perspective, I would say that uh, we should probably keep a gap of around 200 basis points. So, for example, we expect the Fed to go up to 375 as of now. So maybe then the RBI can go somewhere around 575 to 6.
Is that your expectation of
Yeah,
where we'll
yeah,
peak out in
yeah,
this
yeah,
cycle?
yeah.
The OIS markets at one point, I think before last policy were saying higher than 7, although they've calmed down now. I think they're suggesting again 6.3 or so. So the cycle as it goes, and you alluded to a cut being expected next year. Can you tell us, what the trajectory of the economy would be that would take us to that cut?
Yeah, so we think that growth for India would probably come down to about 5.5% next year, from 6.7% this year. There is a downside risk to that, in the sense that if the US were to go into a recession, which it seems to be going into, that kind of typically has posed about 100 basis points, uh, hit on growth for India. So from that perspective, we think that, growth for India will come down to the 5 handle next year. And like I said, inflation should also soften somewhere down the line, as the Fed keeps tightening, commodity prices should also come down. And that should give us the headroom to start cutting rates beyond a point. But then I think at the same time, uh, it's not wise to go back to negative real rates,
Yeah.
on a permanent basis. If there's a shock, you'd have to, that is fine. But as the world normalizes, it's not wise to run very high negative real rates, because that typically, as the Fed is also finding out, typically leads to high inflation later.
Absolutely. Indranil, just switching to the FX side now, as always, when the rupee hits round numbers, you have some sort of nervousness that seems to kick in. But this bout of weakness in the rupee was fair. I mean, nothing to worry about. It was in line with the dollar. It was less than the other developed market currencies. Yet we did see the RBI intervene quite aggressively from what the numbers are suggesting.
So I will make 2 3 points here. Number one, we are looking at the rupee going to 76.50 by March. This is predicated on the dollar, retreating to 110 a euro. So I think there were three sets of factors which led to the rupee depreciation right now. First is seasonality. The rupee is typically always been weak in the first half of the fiscal, and it turns around in the second half, because April to September you have the summer and the rains that reduces production, exports, and vice versa. So that's number one. Number two, the dollar was strengthening because the Fed was hiking, the ECB was not. So that led to strength in the dollar. Now that the ECB has begun hiking, and at least it seems they will be surprising on the upside, the dollar should also start to retreat. Thirdly, oil prices have gone up. But I think typically we have seen when the Fed starts to tighten, uh, and US growth slows, and that's also the same thing as saying the world growth slows, uh, you see oil prices coming down. So I think that we will be in a very, very different world in terms of the rupee by March. So that's number one. About the RBI, I will say that, actual sale of FX is probably been about $30 billion. Although the headline drop in FX reserves is, I think $50 billion odd, because there is revaluation, and at one time the RBI has also, been buying on the forward side.
Hmm.
So net, I think we've lost about $30 billion. So I imagine we are somewhere around 615, $620 billion right now, inclusive of forwards. Uh, and I think that, our calculation is that if the RBI sells about 70, $80 billion, we'll end the year with about 590, assuming the euro goes to 110 a euro. So I think at certain times you still have to intervene, because to guide market expectations, because otherwise the market thinks that, you can go anywhere. But the point I will make is that, if the dollar has depreciated against the rupee, it has appreciated against euro, it has appreciated
Yeah.
against JPY, against everything, I think, all major currencies barring CNY. So this is a not a rupee weakness like 2013 or 2018, but dollar strength. So I would think that, the RBI shouldn't waste too much of FX reserves right now, like the way in 2006 Dr. Reddy had not sold
Hmm.
when dollar strength was depreciating them.
I have two follow-up questions here. One, a slightly technical one. Their strategy on the intervention on the forward side seems to have backfired on both times that they have gone heavily into the forwards market. Is that because the forward market is just not deep enough to be able to take such sort of heavy change in stance from the central bank?
So I think that, when they were buying, there was, you had to buy in the forward space, because you otherwise you were going to add to
Liquidity.
liquidity, domestic liquidity. So I think there was very little other option you had. When you intervene on the other side, I think that, because the forward market is not that deep, intervention in forwards is not as effective as intervention in spot. So I
Hmm.
would imagine it's better to collect the forward and then, intervene in the spot market. And this is something that, we have seen even when, in 2004, when there was a this report on instruments of sterilization,
Hmm.
that spot intervention actually, probably is far more effective than forwards.
Uh, in the current sort of bout, I mean, they seem to have sucked out perhaps more liquidity than they anticipated. And that means that, both credit growth and the FX operations, liquidity surplus has come down, a little bit more than what the market had earlier anticipated. Does that change their calculus in any way? Certainly, there's no need to talk about CRR hikes, etc. anymore.
No, but actually, that is what will allow OMO, because if you see the bond market, you are looking at a 5 trillion excess supply of GSECs.
Yeah.
So the only saving grace is that as the RBI keeps selling dollars, they will be able to do OMO. And so far, the RBI, of course, has not. But I am guessing that, at some stage they will step in, because otherwise the market simply can't clear. I mean, any basic math you take, the market can't clear. So I mean, that is in a way the good news for the bond market, that there will be OMO to cap cap any rise in yields.
They'll be able to explain that away when they're in tightening and rate hiking mode to be able to come in and
I think that, by now the markets, we have seen several rounds of this, and the market is fairly well able to handle, this sort of thing. And I think the last policy, Mr. Das actually said that we will do
yes.
something on the bond side eventually. So I do not see any contradiction. I mean, the whole point is, are you offering excessive liquidity? Clearly not. So
Okay. Yields have been slightly better behaved than, again, one would have anticipated. Is this, because there is an expectation that the RBI will step in? How much do you think the local bond markets will also move in sync with what's happening in the US in terms of yields?
So I think bonds right now are a falling knife still, and I would be very wary of anyone buying unless you're sure that you will be nimble-footed, because the Fed is not done with hiking. Typically, we have seen that inflation driven by cheap money takes a long time to come down. The RBI will be also hiking given where the Fed is, and and there is a big deficit in the bond market. So we think that we are looking at the bond yields touching 8% sometime this year. Next year, we think that there can be a sustainable move to 7%, because as growth and inflation come down, as the RBI starts to cut. But I would be very, very worried of too much of bullishness in the bond market right now.
A word, Indranil, quickly on the flows situation. I know there's been some reprieve from the selling. There's some expectation that even on the bond side, flows will should pick up at these levels. But in a year like this, with the Fed tightening, quantitative tightening, it's tough to anticipate a steady flow of money coming into the Indian markets, equity or bonds.
Yeah, so we've seen that there are three drivers of FPI flows. Number one is the currency. I think the rupee is holding, and that's been our call. So that's number one. Second is the Fed, which has obviously moved to QT. So when the Fed does QT, it's not easy to get money, and we are not getting money right now. And third, to some extent, is China, because if China is very strong, money goes to China. Money from emerging markets. If China is very weak, these funds see redemption. So a slightly weak China is when India gets flows, because people, sort of spread risk. But yeah, so we think that we could end this year with about minus $20 billion of FPI flows, outflows, that is to say. So that's number one. Number two, I think that it is only when the foreign debt investors perceive that the 10-year has peaked, and maybe that could be somewhere around 7.75 to 8%, is when probably they will come in. Because you have a situation where that there is a rate cycle, and that the central bank will not allow too much of rupee appreciation. So obviously, it makes sense to wait for better entry points, I would think. I think that, if the rupee were to go back or stabilize somewhere, around 76, 77 levels, and bond yields go up somewhat higher, as I expect, that is a very attractive, 775 or so, that is a very attractive point to come in, because again, we are looking at the dollar depreciating next year to 115 a euro. If that happens, then you will not see any depreciation of the rupee.
Indranil, last word, coming back to the near term. So 50 basis point hike is what you're anticipating. Would there be any change in the messaging or the stance that we should anticipate this time around?
So I have never been a very great
follower of the stance, which
follower
keeps
of the
changing.
stance, because it can say anything and everything. So I mean, beyond a point, I don't think we are. See, when you are in a situation where there is a domestic issue, and it's a matter of trying to anchor expectations, maybe the stance has a role. But here you are in a situation where you have to basically adjust the relative price of the rupee. So there, I am not so sure that the stance. Obviously, if you say that I am accommodative and I am raising rates by already 130 basis points, so I mean, I think it's just. I think that is probably an element which could have been avoided to begin with.
But they've taken that out now, so I guess some of that confusion is done.
I mean, yeah.
All right, Indranil, I'll leave it at that. Thank you so much. Always lovely to chat with you.
Yeah, same here.
Thanks so much for watching.